Mr. President, dear Mario, Madame la Présidente, cher Daniel, ladies and gentlemen, Mesdames, Messieurs, and I include my fellow governors who are friendly enough to be with us this morning. To all of you, bonjour et bienvenue à Paris. It's a particular pleasure to welcome you to this conference on financial supervision and the role of national authorities in Europe. What better way to inaugurate the new headquarters of the ACPR, France's Supervision Authority for Banks and Insurance, than to bring in colleagues and experts from across the continent. I urge you to look at a few street names in the neighborhood. This borough is called in Paris Quartier de l'Europe, very much in the spirit of what we are doing together at the SSM. I warmly thank President Mario Draghi for being here. Before giving him the floor, let me stress that we have all reasons to be proud of what has been achieved for banking union in the past few years. Proud, but not complacent. There are two priorities still, one in substance and one in method. First, our priority in substance, strengthening the second pillar on resolution. Now that we have had the single supervisory mechanism up and running for 4 years, it's easy to forget that there were many skeptics who were sure that such a union could not be achieved. But as Mark Twain would have said, we didn't know it was impossible. We didn't know it was impossible, so we did it. Today, it is a tangible reality. In fact, our supervisory practices have been harmonized upwards. Our legal framework is stronger thanks to the single rule book, and European banks are sounder. The core equity tier 1 solvency ratio for major institutions has increased by more than 3 points since 2014, from 11.3% to 14.6% at the end of last year. Cher Daniel, liebe Sabine, and all your team, you deserve our congratulations on this achievement. Yet, banking union second pillar, the single resolution mechanism, SRM, is still incomplete. Yes, we have already managed our first cases, substantially improving the health of a number of banks, notably in Spain and Italy. But making the SRM fully operational should be our top priority. In my opinion, it is a common backstop to the Single Resolution Fund that is really the key. Experience from abroad is instructive. In most large jurisdictions, in particular the United States and the United Kingdom, the intervention capabilities of resolution funds are backstopped by the fiscal authorities. And they are not a burden on public finance, since any public outlays are generally reimbursed by the private sector. The EU-area agreement in principle on the backstop, reached on the 29th of June, is a crucial first step. It is now urgent to deliver on it by the end of this year. Two key issues remain, at least. How to fund the backstop at a sufficiently high level to be credible, and how to create a swift decision-making process to deal with emergencies. If we need weeks to activate the backstop, then the backstop is useless. The euro area also needs a system for providing liquidity to financially sound banks after resolution. One that is provided by the euro system and secured by a high-quality public guarantee. Once we will have a credible and efficient mechanism for resolution, it will be much easier to reach a pragmatic compromise on deposit insurance, probably with a focus on liquidity sharing between national guarantee schemes. But to put it in a nutshell, the second pillar is a priority compared to the third one. Let me add on substance two thoughts. First, on anti-money laundering, AML. In this area, I am convinced that we need to enhance our approach by building on a network of national authorities and EBA that should ensure an effective single AML supervision. This means that EBA should have the legal and human capacities to foster convergence of practices on the best standards based on clear European mandates. It should go as far as including effective breach of law reviews and a capacity to directly intervene in some cases with European-wide impact. Second, what we have achieved for banks can serve as an example for financial markets. If we truly want to enhance financial integration and capital markets union for the purpose of better private risk sharing and convergence across Europe, we should, in particular, strengthen ESMA's role as a supervisory authority, at least with regard to wholesale market oversight, while duly involving national authorities when appropriate. I come to the second priority in method, developing synergies within the SSM as a whole. After only 4 years of existence, SSM is now fully operational, with more than 2,300 supervisory decisions in 2017 alone. Those of you who work within the SSM are the living, breathing reality of European integration. Every day, you prove that closer cooperation and even closer union is not a dream of the past, but something we are still capable of today. Part of the SSM success stems from its design. The mechanism constitutes an original model of federalism, based on a close and continuous collaboration between the ECB and national authorities at all levels, from the composition of the supervisory board to the joint supervisory teams, the GST, with which many of you are familiar, the on-site teams, and staff secondments. This does not mean, obviously, that all is rosy, and that culture and practices have fully converged within the SSM. Success allows us to consider now how the day-to-day functioning of the SSM can still be improved. In our view, there are 3 main strategic priorities. The first one, and we work together on that actively with Daniel and Sabine, the first one is to further simplify processes. I welcome the current initiatives, including the creation of the Simplification Group, co-chaired by Petra Senkovic from the ECB, and yes, Edouard Fernandez-Bolo, Secretary General of the ACPR. And Edouard, I use this opportunity to greet you in your new home. Various measures are under development, like the growing use of delegation or the streamlining of STREP or GST functioning. However, an essential challenge will be to make sure that all processes will remain optimized over time and that simplification becomes a full and permanent part of decision-making from conception to execution. The second priority is to promote mobility, thanks in particular to staff secondments and more on-site supervisors working on banks outside their home country. Other initiatives could include very short staff exchanges or swaps within GSTs between the ECB and national authorities to allow members to better understand the culture and practices of their counterparts. The third and final priority is to develop synergies. Just as with the Eurosystem, the banking union constitutes a system with a strong center and strong national components, which ultimately have to act as one team. The goal is to make the best use of national resources by fostering their participation in all key tasks of the SSM. National authorities should not hesitate to step up, yes, this is true for us, to step up their involvement in the SSM. In return, the ECB should further empower national authorities. Speaking for France, the ECB can obviously rely upon the ACPR. Its well-trained employees and inspectors are fully committed to serve the SSM common good alongside the ECB colleagues. And this is also my personal commitment as chairman. As regards on-site inspections and cross-border missions, further efforts should be made in order to tackle administrative hurdles. But I can already say and commit that the ACPR will aim to double its target of cross-border missions in 2019. Strong cooperation is needed beyond banking supervision. Let us not forget that a majority of national authorities are competent in other fields of supervision which matter for the SSM, such as insurance, which is the case for the ACPR. These competences are valuable not only for the supervision of financial conglomerates, but also for the development of a more unified single market for insurance. In cooperation with EIOPA, and I welcome its chairman, our friend Gabriel Bernardino, we are committed to preserving this unified single market for insurance after Brexit. Let me conclude. 10 years after the collapse of Lehman Brothers, we have learned at least 3 main lessons. First, we need competent, strong, and independent supervision. Second, we need a level playing field, at least in Europe, and if possible at the international level, for the implementation of the strengthened rules. Without demanding supervision, regulation, and the single rule book could largely remain a paper exercise. Last but not least, we must never let our guard down when it comes to financial stability. Anniversaries have to be a protection against the temptation to forget and fall asleep. And this temptation exists today. The SSM is the fruit of all these 3 lessons. And under your responsibility, the best guarantee for the future. Thank you for your attention.
Well, thanks, Francois. Thank you, Danielle. Dear colleagues, it's long been understood that deeper financial integration will lead to a better functioning of the economic and monetary union. And when the euro was first introduced, there were encouraging signs that this integration was taking place. Price-based indicators of financial integration showed a pronounced increase, and the standard deviation of interbank lending rates across the euro area fell close to zero. Quantity-based measures of financial integration, however, only adjusted sluggishly, as crucial parts of the banking sector, such as retail banking, remained mainly national. Financial integration proved to be shallow and reversible. At the outbreak of the crisis, interbank markets fragmented along national lines and threatened the integrity of the single currency, laying bare the existing fault lines in our monetary union. One of these fault lines was the fragmented system of national supervision and resolution. The tendency of supervisors to promote and defend national champions often prevailed over the union's pursuit of efficiency and stability. Measures deployed during the crisis, such as liquidity ring fencing, may have focused on securing domestic financial stability, but they neglected the adverse external effects on other countries. Domestic policies thus tended to reinforce negative spillovers and exacerbate systemic risk across the euro area. The banking union addresses these shortcomings by pooling national financial policies at EU level. It has two main objectives: ensuring that banks are sound and encouraging deeper integration in the banking sector. European supervision makes a significant contribution to these objectives. Stronger and uniform supervision leads to resilient banks and provides a more coherent policy framework for cross-border lending. European supervision brings three important benefits when compared with the fragmented system of national supervision. First, it does harmonize supervisory practices. It has merged the 19 national approaches into one single supervisory method. The supervisory review and evaluation process allows supervisors to treat all banks equally by measuring risks against the same yardstick and setting capital requirements accordingly. Risk assessments have become more harmonized and systematic, significantly improving the consistency with which capital add-ons are applied across banks. The correlation between banks' risk profiles and capital requirements increased to 82% in 2017 from just 40% in 2014. In other words, banks with equivalent risk profiles in the euro area now face, by and large, similar capital requirements. Second, European supervision adopts a system-wide perspective when monitoring and mitigating risks. Supervisors can draw on a comprehensive data set and information on banks across the euro area. On this basis, experienced staff from 28 different countries can make comparisons, spot common weaknesses, and monitor potential channels of contagion. This has two benefits. It helps to address systemic risks, as better analysis of cross-border linkages and spillovers improves the coherence of macroprudential policies set by national authorities and the ECB, which contributes to reducing excessive risks and cross-border externalities. And it does support the identification of bank-specific risks. For example, supervisors have developed analytical tools to carry out detailed comparative assessments of banks' business models. Comparisons with peer groups have helped identify bank-specific issues early on, which are then addressed with each bank individually. The third benefit of European supervision is that it reduces the fragmentation in the supervisory framework. In the past, broad discretion in applying EU rules led to significant national differences in key prudential aspects, such as the definition of funds or capital and liquidity requirements. The resulting divergences in the capital strength of banks undermine their confidence in their soundness. European supervisors identified 175 options and discretions available under EU law, 130 of which are available to national supervisors and are now applied in a uniform way across the euro area. More harmonized rules have helped to rebuild confidence in banks and reduce compliance costs for cross-border groups. However, the remaining options and discretions exercised by national legislation still stand in the way of a level playing field for banks, and so further legislative action is still needed. Similarly, the decision as to whether a bank should be resolved or liquidated is made more difficult by different insolvency rules. As a result, some harmonization of national insolvency rules is needed to make European resolution more effective. Overall, however, there are these three qualitative benefits of European supervision, and they have been instrumental in making banks more resilient. Substantial risk reduction has also taken place. The CET1 ratio of banks supervised by the ECB increased, as François was just reminding us, by 300 basis points between the end of 2014 and the end of 2017. And funding and liquidity are now more stable. In the same period, banks raised their leverage ratios from 4.9 to 5.8%, catching up with their US peers. Banks' improved strength helps them withstand potential shocks. Recent ECB analysis, as that was published in the latest Financial Stability Review, has shown that the majority of banks would maintain average capital buffers over 10% in the event of an adverse shock, such as a sharp repricing of risk premia or a strong economic slowdown. Despite having a single supervisor and more harmonized rules, the banking market in Europe remains fragmented. 86% of euro area bank lending to firms and households was domestic in 2017. And cross-border consolidation, which is one way to increase cross-border lending, has recently reached new historic lows. More efforts are needed if we want to reap the benefits of an integrated market that helps share risks through the private sector and improve macroeconomic stability in the monetary union. Just a few data from the United States. For example, in the US, retail banking integration has led to a significant increase in the number of multi-state banks. That was not always the case. For example, following the oil price collapse in the mid-1980s, almost every bank in Texas failed, creating a statewide credit crunch. One reason was that banks were not allowed to operate across states. So the balance sheets of local banks were completely concentrated on their home state. In a more integrated US banking sectors, banks have geographically more diversified loan books and deposit bases. By offsetting losses made in crisis-hit states with gains in other states, US banks are more resilient to local shocks and can keep their lending stable. As a result, US credit markets smooth out a quarter of local shocks, which is significant given banks' much smaller role in financing the economy compared with the role that capital markets have. In the euro area, by contrast, risk sharing through credit markets is much less advanced, despite the predominantly bank-based nature of our economy. Only 12% of local shocks are smoothed through credit markets against 25% in the United States. Research finds that during the sovereign debt crisis, Italian banks tightened their lending and increased interest rates more than foreign banks operating in Italy. And this research is Banca d'Italia. So what are the obstacles standing in the way? Of course, there are fundamental legal, judicial, and cultural differences between countries which hinder cross-border integration. But there are also two important obstacles that exist in the area of supervision. The first is related to legacy assets, which have weighed on cross-border lending over the past years. Banks with high levels of legacy assets have reduced their cross-border exposures in an effort to shore up impaired balance sheets. They have also kept their lending low as their ability to build up capital is limited. Similarly, low profitability and uncertainty regarding the valuation of legacy assets reduce the appeal of cross-border M&As, as banks still expect larger gains from internal restructuring and cost-cutting. Significant progress has been made in reducing legacy assets, which include non-performing loans and level 2 and 3 exposures. Over the past 3 years, the NPL stock of significant banks decreased by 1/3. Targeted supervisory action helped banks to draw up ambitious reduction plans and governance structures for the disposal of NPLs. And more uniform supervisory standards and stricter classification make it less likely that new NPLs will emerge in the future. But while NPLs are washing out as the economy strengthens, supported by our accommodative monetary policy, the NPL ratios of euro area banks are still higher than those in the United States. Further efforts are needed from banks, supervisors, and regulators to reduce the remaining stock of NPLs, especially in those countries where the NPLs ratios are especially high. European supervision also needs to continue and extend its work on the valuation of level 2 and 3 exposures. The share of level 1, 2, and 3 assets on the balance sheets of significant institutions has come down from above 30% to 23% recently of significant institutions' total assets. Especially level 3 assets decreased from 188 billion to 132 billion, constituting less than 1% of significant institutions' total assets. But although the average share of level 3 assets on the balance sheet of the largest euro area banks is now kind of lower than US banks, some banks in euro area individually still have a high shares of level 3 assets if compared with their international competitors. And this unquestionably hampers further bank consolidation in the EU. It's crucial that banks have sound and effective valuation and risk management frameworks in place. Therefore, sustained supervisory efforts are needed to identify and address potential problems with banks' valuation and classification methods. The second obstacle to cross-border integration lies with the prudential framework. At present, regulatory capital cannot be freely allocated across subsidiaries of cross-border groups. Banks are required to comply with capital requirements on a standalone basis, and waivers can only be applied to domestic banking groups. Similarly, with the free movement of liquidity across borders is made possible, while the free movement of liquidity across borders is made possible by cross-border waivers, the practical application of these waivers is hampered by the remaining national prerogatives in the regulatory framework, which allow national authorities to apply large exposure limits on intragroup lending and ring-fence liquidity. For example, the requirement to comply with the liquidity coverage ratio at individual level locks up liquidity in cross-border subsidiaries of G-SIBs of up to 130 billion euro. Some of this liquidity could potentially be freely allocated if impediments such as large exposure limit on intragroup lending were removed and euro area waivers granted. The effects may be significant given the importance of intragroup lending in the euro area, which in 2017 accounted for 70% of all cross-border lending. The free movement of funds is a precondition for a single banking market. With the establishment of European supervision, there is less reason to restrict this free movement. European supervision is able to identify and address financial stability risks posed by cross-border groups, reducing the need for national safeguards. And this is all the more true as national safety rates for safety nets for resolution and deposit protection are gradually being shifted at EU level. Removing the obstacles to the free movement of funds could improve financial integration by allowing banks to allocate resources efficiently across countries. US banks, for example, rely on intragroup funding to respond to local shocks and manage the credit growth of their subsidiaries, allowing them to keep their lending and income streams more stable in front of economic fluctuations. Other regulatory factors are also hampering cross-border integration. Currently, the international regulatory framework doesn't treat the euro area as a single jurisdiction for the purposes of calculating capital surcharges. In other words, intra-euro area cross-border loans from euro area banks are considered foreign loans, leading to a higher systemic risk scores and capital requirements relative to their international peers. Against this background, it's crucial that reforms to complete the banking union do not lose steam, so that the euro area can be treated as a single jurisdiction in the international G-SIB framework. Let me conclude now. As much as the global financial crisis has exposed weaknesses in the regulation and supervision of banks around the world, in the EU, such weaknesses were exacerbated by fragmentation. From the early stages of the crisis, the banking sector fragmented along national lines, driven by diverging macroeconomic conditions in different countries and by governments' diverging responses in dealing with failing banks. Differently from the US, a common resolution framework backstopped by public money was absent. Governments that could do so, namely could actually spend money because of their sound budgets, massively bailed out their failed banks. An opportunity for bank consolidation was lost, but their economies were spared a credit crisis after a financial crisis. In other countries where bailouts were not possible due to the constrained finances or because of the entry into force of new regulatory restrictions introduced by the Bank Recovery and Resolution Directive, the crisis lasted much longer. European supervision and the European framework for managing bank failures, of which, by the way, the BRRD is an important part, have made such a cause of fragmentation, namely the different countries' responses to banking crisis, much less likely today. But more, certainly more, needs to be done. Progress in completing the banking union namely, first, harmonizing options and discretions, completing resolution, and laying the groundwork for the creation of an effective deposit insurance is essential. And I'm confident that significant steps in this direction will soon be taken. But let's keep in mind that fragmentation starts with the decision by banks not to operate in regions where the risk return of lending is judged to be insufficient to remunerate their invested capital. Ultimately, what ensures a steady flow of bank lending to the economy, even in times of unforeseen stress or disruption, is a growth-friendly environment, which can only be assured by the appropriate government policies. Thank you.